Hi, bankers. Welcome to another episode of IBS, Institute of Banking Studies. We are going to take the international banking, which is the A module of the BFM paper for the CAIIB aspirants. We move on to the next concept, that is imports. See, we have seen about the regulations and other aspects of export. In this session, we are going to explain or discuss about what are the exchange and trade control guidelines in respect of imports. You know, in imports, what happens? In imports, the goods are purchased from a foreign country and the goods are coming to India. And let us assume a person is importing a car from Germany. So the car will come to India. So we are getting a product or a goods or a machinery or a vehicle. And in lieu of that, the payment of the cost of the car has to be remitted in the form of foreign exchange. So if the person is importing from Germany, the currency of Germany is euro. So the payment has to be made in euro. So that is the thing. In export, it is the other way. In export, the goods manufactured or produced in India are sold into a foreign country. So the goods will go out and we get foreign exchange. Here, the reverse process, goods will come to India from a foreign country and its price has to be paid in the form of foreign exchange. So foreign exchange goes out, goods comes in. So let us examine what are the guidelines, trade guidelines and trade control guidelines and exchange control guidelines. So the first is IEC code. This is applicable even for export also. IEC code stands for Importer Exporter Code Number, and this is a code number issued to either a person is making export or import, and this is issued by DGFT. It's a department functioning under central government under Ministry of Commerce and Industries. Therefore, this IEC code number is mandatory. So whoever wanted to do an international transaction, be export or import, the first and the foremost mandatory requirement is obtaining the IEC code number. There's a specific format, and the person or the entity, they have to apply in that format through their banker along with the bank's recommendation to DGFT, and DGFT will allot the IEC number. IEC number is the same as after the introduction of the GST. It is the same as the PAN number, but they will make an endorsement. So any firm or person who wanted to do export or import, they have to first apply to DGFT and obtain the IEC number. So next is coming to the permission for importing the product. See, we have seen about the foreign trade policy, that's FTP. And in the FTP, the government will list out certain articles or certain products for which no specific permission is required for importing to India. That means any Indian can import those items which are mentioned under OGL in foreign trade policy. I'll repeat once again, foreign trade policy is a document that is issued by DGFT, and this document, the finance minister, you can say the central government, they are formulating the FTP, and that FTP will be announced. Earlier, it was a 5-year FTP that has been changed in the year 2023 because 1520 was on FTP. I think I have already explained. I'll repeat once again. So 2015-20 was the previous foreign trade policy, the tenure. But in March 20 or 1st of April 2020, the new policy has to be formulated and declared. By the time India, not only India, the entire world was under the grip of the pandemic COVID-19, and therefore the government, the central government of our country, they have continued the same policy for another period of 3 years up to 31st March 2023. So from 1st April 2023, they have announced the new foreign trade policy. Unlike the previous years, in the previous years, it was a 5-year policy, but this time there is no end point. That means there is no sunset clause. That means here the policy is effective from 1st of April 2023, and this is allowed to continue. As and when there is a change in the economic sector in India or in the banking sector, in the finance sector, they may change the norms and terms and conditions. So there is no sunset clause or there is no expiry date. This is applicable from 1st of April 2023. So in this foreign trade policy, the government will list out certain products and items or goods which can be imported without permission from DGFT or from the government, central government. So these items are called listed under open general license or OGL. And let us assume a person wanted to import a product. And this particular product, he is coming to the bank. See, I would like to import this particular product. Can you arrange for it? That means the payment has to be made through the bank. Now, what the bank has to do? Bank has to scan the foreign trade policy or the OGL list. And in the OGL list, if this particular product is mentioned, then you can inform the customer you are allowed, you can import. It is already permitted. But if that particular goods or product is not finding a place in that OGL, in open general license, what's the way out? You can request the customer. You have to apply to DGFT and obtain a permission. That permission is called the import license. So therefore, remember, any person, if they wanted to import any product or goods or machinery, equipment, whatever it may be from a foreign country, first he has to look the OGL. If it is there mentioned, he can import. If that particular item is not mentioned in the open general license, then they have to apply to DGFT and obtain a permission. That means obtain the license, that is import license. This import license will have the expiry date, the value, and the party's name, from where this is being imported. All those details will be there in the import license. And the relevance of the import license is the shipment should take place on or before the expiry of the import license. If the import license is expiring on 30th of September, and this is for importing a car from Japan, then the shipment in Japan should take place before 30th of September. That's the implication. Now, so I've explained about OGL and import license. Next, so the question one can be, who issued the import license or who issued the ISC code? Both DGFT. Now, next is payment of import. Importer should apply to the authorized person. That means the importer cannot make directly the remittance. The remittance has to be made through proper channel, means through the bank. So he will go to his bank. I would like to import this particular item. Please make the payment. So there is an application form A1. In that application, they have to apply to the bank, and bank will make the remittance. So the remittance has to be made. What is the time limit? It should be completed within 6 months from the date of shipment. So if the person is buying a computer from Japan and you see the date of shipment in Japan, from that day, within 6 months, the payment has to be completed. Next is coming to the regulation or the rule for advance remittance. We have seen the advance remittance is applicable for even export as well as import. In the case of exporter, means export from India, means the exporter or the seller is in India. This person can demand to the buyer in the foreign country, you make the payment in advance. After receipt of the money only, you will ship the goods. That is possible if the particular product is of great demand, and then they can insist for an advance remittance. Similarly, in the case of import also, the seller in the foreign country, let us assume this person is importing the car from Germany. So the German counterpart, who is the seller of the car, he can insist, give me the money in advance. After receipt of the money only, I will make the shipment. So this is the safer side as well as the seller is concerned, because they get the money first and then they ship the goods. So there is no risk as far as the seller is concerned. But when a customer is coming to you, the importer is coming to you, please make the remittance in advance. Then there are certain guidelines. This also they have asked the question. What is the guideline? The guideline is whenever an importer is coming to you, please make the payment in advance, because before receipt of the goods in India, before reaching the shipment in India, the buyer or the importer is requesting for making the payment. It's a very risky thing. Very risky thing, because you have made the payment. After that, if the exporter is not shipping the goods, it is a great problem, isn't it? Therefore, we have to be very careful whenever there is a request for making an advance remittance. So advance remittance, the guideline is, if the request for an advance remittance for import is up to 2 lakh US dollar, up to 2 lakh US dollar, the bank can allow it on merit. So they have to use the discretion, and within the amount is within 2 lakh US dollar or it's equal in any other currency, it can be allowed. But it doesn't mean that you have to allow for all cases. You have to look into it, and on merits, you have to use your discretionary power and you can allow. And next is, if the request for advance remittance is between 2 lakh US dollar to 50 lakh US dollar, in that case, you should call for either a standby LC or a guarantee from an international reputed bank. So from the foreign bank, suppose the person is importing from Japan, probably from a bank in Japan, they have to either give a standby LC or issue a guarantee. What's the guarantee? When the bank will guarantee that you make the payment, we will guarantee that the goods will be shipped. That's a guarantee. So you have to insist for a bank guarantee or a standby LC from the foreign bank of international reputation bank. Then you can allow if the remittance is in excess of $2 lakh and up to 50 lakh US dollar. But if the request is in excess of 50 lakh US dollar, you cannot. Even with bank guarantee or standby LC, bank is not allowed to make the advance remittance. Then in that case, specific approval from the government or from Reserve Bank of India is needed. So the guideline, please keep in mind this one. There's a probability or there's a possibility of asking those questions. We'll come to the another concept, that is IDPMS. We have seen a similar term in export, that is EDPMS. EDPMS stands for Export Data Processing and Monitoring System. And there is a similar platform that is for monitoring the imports to India. And the purpose of introducing the IT platform by Reserve Bank of India, the EDPMS, the purpose was to get the information then and there. They need not wait for the statement or return from the bank in respect of the exports. Similarly, the Reserve Bank is more concerned how much forex is going out of the country. Because they have to formulate the policies and important policies and other guidelines to the bank and to the public. And therefore, they have to depend on the data from the bank. And sometimes the data may be delayed. Sometimes the data contains a lot of errors. And because of this reason, Reserve Bank of India conducted a survey, and the working group headed by A.K. Pandey, they recommended, CGM of Chief General Manager of Foreign Exchange Division, FED of Reserve Bank of India, why don't we go for a similar platform? Similar means similar to EDPMS. And because the EDPMS was working fine, RBI is getting the detail of the exports then and there. So there is no issue. Therefore, this A.K. Pandey committee recommended we can start a similar platform for monitoring the imports. And because of, based on that recommendation, the new platform, the IT-based platform, has been made effective from 10/10/2016. The first one was in 2014. This is from after 2.5 years, this platform has been introduced by Reserve Bank of India for monitoring the import within India. And this will enable, the submission of BEF statement by banks have been dispensed with. What is BEF statement? Bill of Entry Defaulters. Bill of Entry, you must be knowing what is Bill of Entry. Bill of Entry is the evidence of import. Who is issuing this Bill of Entry? This is issued by Customs Authority. The moment the goods reaches Indian soil, that means either at the seaport or at the airport, the customs will check and they will issue a certificate quoting the invoice number and other things. As per this invoice, the goods have reached Indian soil, and they put their signature and give with date, time, everything. So this is the proof that the goods have reached India. Or I can say this is the evidence of import, the bill of entry. So it is the responsibility of the importer to submit the bill of entry, duly authenticated by the Customs Authority, to the bank. Then only that import file will be completed by the bank, and they have to preserve it for verification by the auditors. The auditors means it can be the internal inspectors of the bank, it can be the statutory auditors during the year-end closing, or it can be an audit or inspection conducted by the Reserve Bank of India. So for all these people, it has to be preserved in the respective file, and after verification, you can close it. Close the file. So this bill of entry default That means there is a time limit for submission of the bill of entry. If the bill of entry is not submitted in time, it becomes a default. Therefore, bank has to send a statement, BF statement, every half year as of 30th of December, 31st of December and 30th of June. And this submission of this statement has been dispensed with because from the data in the IDPMS site, RBI will get the details. So how the data will flow? Let us check. The data will flow. Here, the data will flow. The first one, in the IDPMS site, the first entry is made by the customs authority. Because you see, in export the goods, first the manufacturer take the goods to the customs. Similarly, in import also, the goods exported by a foreign country reaches Indian soil. So it has to pass through the customs channel. So at the customs channel, they will check everything and they allow to take it, to come out, and they make an entry in this IDPMS site. So the first entry of this an import will be entered by the customs authority, and then the documents will come to the bank. And when the document comes to the bank, they will make the payment, realization of the import bill or retirement of the import bill. At the time of retirement of the import bill, the bank will make an entry. So outward remittance, when the bank collect the money from the customer and make the remittance, that is called the outward remittance, or it is a retirement payment. When the bank makes the payment, they make an entry, and subsequently they make an entry. So it doesn't mean that the matter ends there. In an import, goods reaches India, and the customer comes to the bank, make the payment, you debit customer's account, we make the payment. The matter is not ending there. Because whenever a bank is releasing foreign exchange for importing, it is the responsibility of the bank to ensure that the goods have come to India. This is a very important aspect. But I told you, it is the bank's responsibility to ensure that the goods have come. But at the same time, bank doesn't have an authority to go and check whether the goods have come or not. Then what is the way out? The way out is bill of entry. Therefore, bank should ask the customer, importer, whether you have taken the delivery of the goods, then produce the bill of entry. So that is a document evidence of import. So it is the responsibility of the importer to produce the bill of entry to the bank within the prescribed time. So when the customer, the importer, submit the bill of entry to the bank, bank makes an entry. So there the matter ends. Now RBI will come to know the goods have reached by when they saw the entry by customs authority. The payment has been made when they saw the entry by the bank, and they have seen that when they see the bill of entry, the transaction has been completed. And next is this bill of entry should be submitted within 3 months from the date of shipment. So importer should submit the bill of entry, or if it is through customs or the postal appraisal form or the customs assessment certificate as evidence of import within 3 months from the date of shipment. And see, sometimes there is a possibility that the bill of entry has been misplaced by the importer. They have collected the bill of entry from the customs, but in between it has been misplaced. There can be such a situation. So if such a situation arises, what is the way out? Once the bill of entry has been misplaced by the importer, there is a solution provided by the government or Reserve Bank of India. That is, if the import is less than 1 million, if the value of the import is less than 1 million, then, and the company is a listed company, and their net worth is not less than 100 crore. So these are the conditions. So there are 3 conditions. The value of the import is less than $1 million or its equivalent, and the company is a listed company, and their net worth is not less than 100 crore Indian rupee. Then, if all the 3 conditions are satisfied, then a certificate from the CEO, Chief Executive Officer of the firm, or a certificate from the statutory auditor of the company, that can be accepted in lieu of the bill of entry. So the CEO or the statutory auditor of the company will certify, we have imported, the goods have reached India, bill of entry has been collected from the customs authority, but it has been misplaced. So please accept this letter as this certificate as in lieu of the bill of entry. So you can accept this certificate from the auditor or CEO in lieu of the bill of entry. Next is, we'll move on to another concept, that is one is buyer's credit, another is supplier's credit. Remember that we are discussing about the import, the facilities to the importer, or the guidelines, exchange control guidelines and trade control guidelines in respect of import. So here, we have seen about, in export, we have seen various credit facilities for an exporter. Similarly, for an importer, what are the various types of facilities? Buyer's credit and supplier's credit are two credit facilities for an importer. To put it more clearly, these two credits are more or less the same. It is available for an importer. I'll explain it, I'll put it in a simple way. Let us assume there is a firm, for example, say Reliance Industries. They want to import goods worth USD 10 million. So let us assume from USA. So remember, it's a very enterprising unit, company, Reliance Industries in India. Let us assume this company, for their expansion of particular or diversification, they would like to import a machinery, and the machinery is worth, or its cost, USD 10 million. Now the Reliance Industries has got so many options. Either they can buy this machinery out of their own fund from their capital, or they can raise the money from local sources by issuing a bond or debenture from the public, or they can go to a bank and arrange for a loan within India. So either from their own source or from a loan from India, they can arrange the fund, they can buy this machinery. Reliance Industries is not willing to neither raise the fund out of their own source or from the public or by taking a loan from a bank in India. Instead, they would like to raise this fund or avail a loan outside India. So from a bank outside India, they wanted to take a loan. Why they are going for that? There are two reasons. Number one, when they take a loan from a foreign country, the interest rate, when we compare with interest rate in India, it will be far less. If they take a loan from a bank in US, the interest rate will be 2.5, 3% or 4%, at the most 5%. Because in US, the interest rates are comparatively lower than what in India. That is number one. So interest rate is less. And the repayment term is also very comfortable. They make a 10-year period. So 10 million, they have to pay over a period of 10 years. That means every year 1 million principal and the respective interest. So the easy terms. So because of this reason, sometimes a firm may be interested to avail the loan from a foreign country. This is called either supplier's credit or buyer's credit. So I'll put it in another way. When a firm in India, if they wanted to import a particular product, and for that importing that product, if they take a loan from a foreign country, from a foreign entity, from a foreign bank or a financial institution, this is either buyer's credit or supplier's credit. Then when you say it is a buyer's credit, if this credit facility is arranged by the buyer through their influence, who is the buyer in this case? Reliance Industries. If Reliance Industries, out of their influence or through their bank connection, if they are able to get a loan from a foreign country, that will be classified under buyer's credit. So the credit is arranged by the buyer. Next is, the Reliance Industries will say, I don't have any connection, or I am not initiating any step for raising the loan. The Reliance Industries will tell the seller is in US. Let us say ABC Incorporated is a company. They will tell ABC, you arrange a loan. You ship the goods to me, we will make the payment. So in that case, the arrangement for the credit is made by the supplier. That is called a supplier's credit. I think it's clear. So let us go for the definition. This is the definition. Buyer's credit is a credit arranged by the buyer. Means importer. From where? From a bank. located outside India. That's the most important thing. So in buyer's credit and supplier's credit, what are the common things? The loan will be, the purpose of the loan is import. Number two, the loan will be issued or given by a foreign institution. The loan is not availed from India. It is availed from a bank or a financial institution outside India. These are the two common points. And supply. So buyer's credit, look, buyer's credit, it is arranged by the buyer. Supplier's credit, it is arranged by the supplier. That's the difference. Otherwise, it is same. And let us go for the comparison. These are the comparison, buyer's credit and supplier's credit. To whom both the credits are given? Both the credits are for importer. So buyer's credit is for the importer. Supplier's credit is also for the importer. And next, who finance? In both cases, it is the foreign bank. So when Reliance Industries avail either under buyer's credit or supplier's credit for importing a machinery, the loan will be arranged by a foreign bank. So these two are common. Now next is who arranges. Buyer's credit, it is arranged by the buyer, the purchaser or the importer. Supplier's credit arranged by the supplier or the exporter or the seller. Now what's the maximum period? For non-capital goods, the maximum repayment period is 1 year. For capital goods, it can be 5 years. And in both for buyer's credit and supplier's credit, and all in cost, total interest, total cost, that it includes the interest, the discount, the commission, everything put together should be ARR plus 300 basis points for new trade credit and ARR plus 350 basis points for existing credit. ARR means alternate reference rate, and that plus 300 basis point means 3%, other 350 means 3.5. And it is the same for supplier's credit also. So all in cost and maximum period is the same. Now coming to the amount under automatic route. See, there are two routes for import. One is automatic route and there is approval route. Automatic route means no specific permission is required. For up to a certain amount, the bank can allow the permit, make the remittance. So under automatic route, it is 150 million per import transaction for specific companies. What are the companies? If it is an oil gas refining or a marketing or airline and shipping company, it is 150 per million. Otherwise, it is USD 50 million per import. The same thing for both buyer's credit and supplier's credit.